According to Jim Rickards with Strategic Intelligence, by some measures, the U.S. economy has been in a depression since 2007, despite long periods of slow growth. Fiscal policy that involves direct government deficit spending does produce growth that monetary policy cannot. The question is, at what cost? A neat example would be a national debt-to-GDP ratio of 30% and deficit spending on a productive project, such as improved highways, ports, or public transportation. In that situation, $1 of additional government spending financed with debt might produce $1.40 of GDP. That excess growth, or 140% of the amount borrowed, is called the Keynesian multiplier. Today, none of these conditions apply. The national debt to GDP ratio is 134%, the highest in U.S. history. Government spending is often directed at non-productive projects, such as the Green New Deal and handouts to illegal immigrants. Unemployment is low, which means the economy has limited spare capacity. In these conditions, the Keynesian multiplier is not 140%. In recent quarters, it has been as low as 60%. This means you borrow $1, you spend $1, and you only get 60% of growth. When debt rises faster than GDP, as in this example, the debt to GDP ratio grows and the multiplier shrinks. You're trying to borrow to spend your way out of a debt crisis, which can only end in default. Unnecessary, since the U.S. can print dollars, or hyperinflation, which is more likely. Any debt to GDP ratio above 90% will produce a Keynesian multiplier of less than 100%. As the ratio rises, the multiplier shrinks with a debt to GDP ratio of 134%. The U.S. can only expect more debt and weaker growth from fiscal policy. The U.S. and much of the world is following the same path. Stagnation in the form of weak growth and occasional recession is the future of the U.S. economy, despite recent strong quarters. The stagflation hypothesis is entirely intact. This is all according to Jim Rickards with Strategic Intelligence. I have followed him for many years. The Fed is looking for signs that inflation is coming down, but they're not going to get them. He says we'd have to see lower inflation for April, May, and June for the Fed to cut rates in July. Don't count on it. And the Fed models are questionable at best. Again, this is information from experienced, reliable sources. Take heed.